Hey everyone, welcome to the show. Today we are joined for a one-on-one conversation with Daniel Schreiber. Daniel is the co-founder and CEO of Lemonade. We're going to talk all about the state of the insurance industry. Daniel, certainly something that you are a total pro in that I know matters deeply to a lot of our viewers because there is a lot of misconception, a lot of distrust of many of the big players in the space. So I want to start with a conversation about the insurance prices, kind of the state of the industry overall. Insurance prices, as you know, in the US, specifically for home insurance, has absolutely skyrocketed. A lot of distrust in those big institutional players. Sometimes insurers have even threatened to leave markets, meaning they then have very little access to private insurance. Talk to me about your take on the sort of macro trends, the big pictures that we're seeing across your industry.
Sure, great to be with you. And yeah, absolutely. It's been crazy times. Well, in the economy, inflation and other things have gone wild, and they've really had knock-on effects on insurers in pretty dramatic ways. So if you think back the last couple of years where inflation became a major source of concern and interest rates were raised in order to contend with those. So inflation reached, what was it, 9% in the US, something like that. But in a couple of sectors, it was much higher than that. Home repairs were in the 20-something%. And cars and car repairs and parts were also 20-something% inflation. And in the early stages of COVID, it was even worse. The supply chains got all messed up during COVID, and getting parts to repair your car became impossible. You had to wait months to do that. All of that has a massive impact on the insurance premiums as well, because ultimately the company that pays for all of those parts and for all of those repairs in your home, in your car, is your insurance company. And for the longest time, they couldn't raise rates in line with inflation for the simple reason that insurance prices in America are set by regulators, or rather they need to be approved. Insurance companies are not free to change prices fluidly as costs change. They have to ask regulators, by the way, 51 regulators throughout the United States. So this isn't even something you do once and you're done. You've got to go regulator by regulator and get approvals. So we have seen that it's been time lagged. All of these huge costs have built up. Inflation did that. And then suddenly insurers get all these new rates approved, and we as consumers get smacked with a huge bill, which is indicative of the rise in costs, but it's come at a time offset in a way that really startles us when it happens. What's made things worse, of course, in home is climate change has really impacted. We've seen some of the worst years ever. And because of some of the, in part at least, because of some of the distortions in the insurance space, a lot of us have been lulled into buying homes in places that really humans perhaps ought not live in, because they're flood zones or they're hurricane exposed or they're wildfire exposed in a really bad way. And because of the way the industry worked, that might not have been reflected in your premiums. Suddenly it is. And you're being really hit by very hard to contend with changes to your homeowner's policy for that reason as well.
So you diagnose the challenges, but how is Lemonade responding to those trends? And how do you see yourself effectively able to separate yourself from a lot of the other players?
Lemonade's big differentiator is that we're built entirely on a technological substrate. We founded the company in 2015, and back then we kind of said, we're about technology and AI. AI is a buzzword today. It wasn't in 2015 when we established the company. And we've been doing everything in a very data-centric and automated way. And that means that almost all of our policies are sold without any human beings. 98% of our policies are sold, no brokers, no agents. You just interact with a bot and you'll buy yourself a policy. It takes 90 seconds and costs a fraction of what it would otherwise cost because we're collapsing costs by using automation instead of people. The same is true when you handle claims. 98% of our claims are taken by a bot. You talk into the camera, you explain what happened. Taking costs out of the system is a huge advantage to consumers. It results in the fact that you can buy policies in seconds. Literally 90 seconds is the average time to buy one of our renters policies. It takes twice as long to get a latte at your local Starbucks. And we pay claims in as little as 3 seconds. About 50% of our claims are paid automatically by those AI. So you get a better user experience, but the deeper advantage is we're taking costs out of the system. So when you don't need tens of thousands of employees, you got instead of that tens of thousands of artificial intelligences doing that kind of work, you do see that pass on. So our policies start at $5 a month. And in places where we can use technology, for example, if you buy one of our car insurance policies, we use telematics. So you enable us to track your driving behaviors. And then if you are one of the people who drives responsibly, and about 2/3 of consumers do, it's just that the insurance companies don't know how to identify them. So they treat us all as if we're kind of average. But because we use technology to be able to identify how you drive, we're able to pass on those savings to you as well. So you do get, if you're a responsible human being, you tend to get much better rates at Lemonade than elsewhere.
So we'll drill down on climate, we'll drill down on AI as well, more in the conversation. But to that point, is it tracking that gives you a sense on safe drivers versus not? Because this has been a controversy, not so much for insurance companies, but for a lot of the big auto manufacturers. So it was later discovered has sort of tracking technology to help effectively determine who is and who is not a safe driver. What does that look like? And then in terms of data that you may be able to effectively collect, ensuring that that data stays secure in a world where, Daniel, as you know, it seems like every week we got another headline about a big data breach.
Yeah, you're absolutely right. So yes, it is data. The trade that we make is, the way traditional insurance works. If you're comfortable with it, then go for it. But it's got a lot of stuff to dislike about that as well, right? Your car insurance policy today takes into account whether you're a man or a woman. That's a legitimate rating factor because it turns out that the sexes drive differently, and therefore that becomes a rating factor. Your credit score will be in there as well because people with better credit scores tend to be better driving risks as well. Your marital status, your educational status, the proxies that we use today to price insurance are not all that palatable either. But if that's what you prefer, if that's the way the industry works, you can go for it. The trade that Lemonade offers is, hey, we don't love using all of those. We want to look at you and how you drive. And if you give us access to your phone or you plug into your car, whichever you prefer, we've got both options, a little device that will allow us to track how you drive. We will never sell that data. We have no part in those controversies that you're talking about because those are people who take the data surreptitiously and then sell it to third parties. We don't take it surreptitiously. We ask you explicitly for permission to track. We will use it solely in order to give you the best rates that we can. So it's data that you allow us to take and you know exactly what it's being used for. And most customers like that trade. They want to be good drivers, want to get the advantage of being good drivers. They want to be able to demonstrate that they're good drivers. There are other benefits, by the way. We can detect if there's a crash and get help to you straight away because we've got the accelerometer on your phone active and we can detect crashes. One of the things that we do for our consumers apropos climate is we plant trees to offset their driving because we know how much driving you're doing. We can do a pretty precise calculation and do some tree planting to offset the carbon footprint. So it has a lot of advantages, but we're very open about it, and it's not right for all consumers. I think for a lot of consumers it is.
Let's now talk about that artificial intelligence component, because you said AI has been important to your business, crucial since 2015, long before it was the splashy buzzword that it is now. How are you using AI to decide where to offer policies, the location component that comes from these language models?
It's not just language models. Anytime a consumer comes to Lemonade, about 50 different machine learning models, AI models, will be making a series of predictions. Where they live, the location will be one of those components. And we have climate models that we've ingested and that the machines are familiar with, and that will be part of it. But these 50 different models are making predictions such as, how likely are you to churn? Are you the kind of person who's likely to stay with us for a long term? How likely are you to make a claim? And what kind of size claim are we expecting you to make? And for any individual, we'll be wrong. But on aggregate, these things are pretty precise. It's kind of prescient and amazing what AI is able to do. And the reason this is so important is because we spend money to acquire your business. We'll be paying Google or Facebook or YouTube or wherever we're advertising to get your attention. And we want to make sure that every dollar that we spend will be well spent and that we will get a lifetime value that will be a multiple of whatever we're spending. And I don't think there's another insurance company in the world, certainly not in the United States, that's able to fine-tune its customer acquisition spending in real time based on kind of LTV predictions that are being made at a machine learning level, or 50. It's an amalgam of about 50 different machine learning models, and about 90% of our spend is targeted this way. So it allows us to just refine the speed with which we're responsive to all different changes in prices, in competitive environments, in conversion rates, in claims behaviors. All of these are fed in and through the machine instantaneously and will impact today's campaigns.
So nearly every CEO I've interviewed, Daniel, at some point I like to ask about the stock price, and I've gotten, you can imagine what the types of answers are. Oh, we don't really look at the stock price. That may be very much true, but I am fascinated with the stock performance for Lemonade, because the last 52 weeks, the stock basically tracks the S&P 500. You're right about at its performance, which has done very well, but it's a different story if you just truncate it to year to date, where since the start of 2024, it seems like the market is off and running, whereas the stock is up about 3.5% as of this morning. Do you view your company as an AI play at all? And if so, why this year do you think the stock has maybe not been quite able to ride the wave of AI momentum? Or do you view this fundamentally differently in terms of stock performance, although AI is important to what you do, not necessarily part of the overall AI conversation in the markets?
I do like that framing. I think that's a helpful way to think about it. We IPO'd just over 4 years ago at $29 a share. Our company is 5 times bigger now than it was then and is cash flow positive. So we are, by any conventional measure, far more valuable now than we were when we IPO'd. And yet we're trading at a lower price than our IPO price. And what we saw was a really wild increase in the stock value as we IPO'd. So we IPO'd at 29, but we opened at 52, and then we zoomed all the way up to 180 at some point. And I have to tell you, I felt uncomfortable at those levels of valuation. The company, as I say, was dramatically smaller than we are today. And while it's looked like a kind of something to celebrate, implicit or implied in that kind of valuation was a set of expectations that were just unrealistic. And we were bound to disappoint. And there's a limitation to what a CEO can publicly say about this at the time. But internally, I told the team not to get too married to that kind of a valuation, that it wouldn't last. And as somebody reminded me a couple of months ago, I did a town hall when we were at 160, and I said, I want you guys to know that this isn't real, so that when the stock drops to 12, you'll remember that I said that, and I'll say it again. And then we dropped to 12, and I got a phone call from one of my team members saying, I remember, Daniel, 2 years ago you said. So all of our stock movements, or the overwhelming majority of our stock movements, up and down, have been triggered by macroeconomic trends. They didn't occur or didn't coincide with any announcements by the company. The Fed had much more impact. Inflation had much more impact. Interest rates had much more impact on our valuation and on huge movements in and out of stocks in general, and growth stocks in particular, and post-IPO stocks even more in particular. So we were traveling with a cohort of other stocks, and the weather was buffeting what happened to our stock much more than anything that Daniel said or that the company delivered. So I think, first of all, you just need a sense of a certain humbleness and in recognition of both the good and the bad in the stock of the last couple of years. We've really been moving in ways that have reflected, for good and for bad, very little about the company. In the medium term, in the long term, I have no doubt that, yes, the AI component is what's going to drive the stock's growth. And by the way, as uncomfortable as I was at 160, at $17 or $18, I have the opposite dynamic. I feel very confident that I know how to deliver shareholder value to anybody buying at 17 or 18, because I do believe that the company is going to 5x and then 10x and then continue to grow because of the dynamics that we spoke about earlier. And a lot of it does come back to AI. Our ability, and you see it in the numbers, by the way, the size, the amount of premium per human employee that we've been able to service has trebled over the course of the last couple of years. We're seeing this in other ways. Our revenue grew 25% last quarter. Our headcount shrank by 9%. We are seeing just the efficiencies. Our operating expenses haven't moved in 2 years, even as we've grown by 50%. We are seeing the AI deliver the kind of efficiencies of scale that you want to see. So while this was our founding hypothesis, any investor looking at our fundamentals over the course of the last 2 years doesn't have to believe in any kind of magical formulas, just in straight lines on a graph, because that's what we're delivering.
Daniel, I got to say, there's a lot more transparency to that answer than I usually get from people in your position. So I do appreciate that. I think it's fascinating in general to look at how all the insurance companies, yourself included, have performed. The stock charts, they sort of look unlike any other sector that I've studied in terms of the wild movement. And you can tell, you can see a direct impact on the implications and the perception of interest rates. What is the Fed going to do? So actually, I hadn't planned to ask this, but since we are coming up on September 18th, that FOMC meeting where we finally expect a rate cut, is that the sort of thing you think is a boost inherently, or has that become a headwind given the expectation of a falling federal funds rate, presumably starting in a few weeks, for a interest rate cutting cycle that, as you know, could go on for the next 18 to 24 months?
And here I'll give you the answer that you said you get a lot. It has the benefit of being the truth. It doesn't preoccupy me. If I was a betting man, I'd say yes, it'll be a boost because growth stocks benefit from lower interest rates. So I think it's likely to be a tailwind. But sincerely, we're very focused on building a valuable business and managing the business and delivering. We've been in market for 15 or 16 quarters, and we've delivered or over-delivered or beat expectations 15 out of 16 quarters. That's what we're focused on. I have no doubt that it will reflect itself in our stock price over time. But if that happens next quarter or next year, we're in this for the long run. We're looking to build an iconic, very large insurance company. Insurance companies get to be 40, 50, $100 billion in size, and they get to last for 100 or 200 years. That's the prize that we've kind of got our eye on, and therefore quarterly gyrations of the stock price in the scheme of things don't, honestly, around the table, both my dining room table with my wife and my kids and the management table, and the boardroom table, we spend no time talking about the question they ask me about, will that help the stock price for next quarter? Just not something we're managing towards.
Yeah, sure. And before I jump to climate, you mentioned when you went public, I went back and watched that bell ceremony from the New York Stock Exchange. You're doing that in the thick of COVID. I mean, summer 2020, only a few individuals up there on the podium wearing masks. Was there not to bring you back to a time I'm sure in many ways you love to think back about, but also in many ways you'd rather forget. Was there any consideration to say, let's let this sort of pandemic play itself through and maybe we eye 2021, or was that your goal? Because I feel like you went public at a time when there was a lot of uncertainty.
There was a lot of uncertainty, and we were a young company. We had just made it to $100 million of premium or ARR kind of equivalent, which is small for a company to go public. We were 4 years old, which is young for a company to go public. So we had made our peace with the idea that we would be in a volatile, stock markets are volatile for everybody, but for young, small companies, they are particularly volatile. So we knew that was a likely outcome. And, just a couple of months before the IPO, we thought there's no way it's happening. We'd done the legwork and it just looked impossible. And then suddenly the markets opened and we had already done the meetings and the banking work, et cetera. So we were one of the first companies when the window opened. COVID saw a massive stock market crash, an absolutely crazy crash. And we had our first meeting with the bankers on what in retrospect turned out to be the low point of the cycle. The stock the preceding 50 days had been, I think, the worst 50 days in the history of the stock market, something like that. And so we all convened because we had it on the calendar. And I remember opening the meeting and saying, guys, we're doing this because we said we're going to do this, but obviously there's not going to be an IPO. And then the next day, the stock market started going back, and that became one of the strongest rallies of all times. Kind of in March of 2020, it turned around, and suddenly we're like, okay, maybe it is happening. And so, yeah, that was a pretty wild ride.
Yeah, and we basically went up and to the right from that point up until we started to get the first interest rate hikes just a couple of years ago. So thank you for taking that trip down memory lane, because I actually think it's important for viewers who look at companies and really want to hear from someone in your position about the contributing factors of consideration that gave you confidence to go public. And like I said, I track companies at the New York Stock Exchange every day. And I went back and said, man, that's a time capsule in a moment in time for sure when you all decide to hit the public markets. Okay, well, let's talk a little bit about weather-related disasters. I think this is really important to the conversation. Millions of Americans were forced out of their homes last year. And in the last few days, we heard from FEMA saying that their disaster relief fund is already out of money for 2024. We haven't even really reached the heart of hurricane season yet. What is climate change doing, Daniel, to the state of homeowner insurance?
Well, it's clearly devastating, and maybe we can peel it back from a few angles. I'll start off perhaps in a counterintuitive or in a non-obvious place to start, which is I think the insurance industry has a lot to answer for in a couple of senses. One is that the US insurance industry has been one of the biggest investors and enablers of polluting industries. I haven't seen the most recent numbers, but a couple of years ago, about $500 billion of insurance premiums were invested in polluting industries. And there is something absurd, perhaps even obscene, of me taking your premiums, and whether it's life insurance, health insurance, home insurance, in all of those situations, which is a lot of your premiums, I'm offering to protect you against the effects of pollution and climate change, polluting industries. And yet I take those premiums and I invest them in the very things that are causing so many of the harms that I'm protecting against. And that has been and continues to be the way the industry has operated. A few years ago, Lemonade, we were a B Corp, and we try to be thoughtful about these things. We were the first, and I think are still the only American insurance company that has promised not to invest any of our customers' premiums in polluting industries. In addition to that, I mentioned earlier, when we do car insurance, we plant trees to offset the pollution of all of our customers. We also have a give back program where a portion of our premiums goes, and a lot of that has gone to charities working in this domain. There's now a Lemonade forest that's being built by a lot of the monies that we've donated. So it is something that we're trying to be thoughtful about, and in ways that are less obvious and perhaps more peripheral, but ultimately very powerful. We're trying to correct what we perceive as some of the wrongs, not to say evils, of the insurance space. There's another problem that is perhaps not obvious, and a lot of people won't thank me for highlighting this, but insurance regulators in some spaces have been are elected officials. They're not always appointed. Sometimes they're elected officials, and sometimes they see the insurance appointment as a stepping stone towards a governorship or some other role. And you do see some populist regulation happening. So oftentimes it's forcing insurance companies to offer unrealistic prices in places that a realistic price would just be off-putting. So in other words, in a lot of places, a lot of floodplains, a lot of places in Texas, a lot of places in Florida, a lot of places in California, where insurance could be serving a really important social function of signaling to you, the consumer, that this is not the right place to build your home. And instead, if that we this sector, the industry, are being forced to use somebody else's premiums to subsidize yours by keeping your rates artificially low, then a lot of bad things happen. One is you see massive population expansions in places that are very weather exposed, and that has happened over the course of the last 10 years. Massive population expansions in flood zones, in hurricane exposed areas, in fire exposed areas. And that may be popular in the short term, but that ultimately that's a bubble that has to burst, and consumers will suffer from that. And I'm afraid that that has happened a great deal in America, in various states. And ultimately, it's the only way that this becomes sustainable is if consumers pay a rate that is commensurate with the risk that they introduce into the pool. This is meant to be consumers coming together, pooling resources, and pooling their premiums in order to cover them. And we're beginning to see in places, you said, like in California, where some of the largest players, the state farms and others, have said, we're just not playing this game anymore, we're going to pull out. And now there's this kind of come to Jesus moment where hopefully we see some reconciliation and some more kind of science-based pricing factors coming back in. But there'll be a period of an adjustment, and a lot of people will find their rates that they were expecting when they bought the home will not be sustained, and there'll be some pain to go around. And I'm sorry for that.
We're about out of time, but I would love to finish up here by just asking about a few of the sort of household name competitors in the space. We talk about a company like United Healthcare, UNH, because for other reasons, it is the most weighted name in the Dow. We talk about names like MetLife because they've got their names on sports stadiums. How do you compete against names like that in the space? What does that look like for Lemonade going up against these big, massive corporate incumbents that do things differently than you do?
I think that's where the answer is as well, that we do things differently. So there has been this traditional understanding that an insurance company comes into town, places its name on a stadium, or if you just think about some of the most iconic buildings in the skyline of New York or San Francisco or Chicago or London, they're insurance companies that are kind of the names of those largest business buildings. So you come into town, you build a skyscraper, you put your name on it, and you truly try to project your financial prowess by building the tallest skyscraper or naming a big stadium. And I think that was a way in which it gave people some kind of confidence that they'll be there for me. And that certainly was the playbook. Lemonade works differently. We think that people distrust the insurance company, not because they suspect that they don't have the wherewithal to pay the claim, but because they don't have the will to pay their claim. And there is profound distrust. Most Americans think that insurance companies won't pay them when their payment is due. There is a conflict of interest in the perception of consumers that insurance companies make money by denying my claim. And so there's a lot that's troubling at the very root and core of insurance, and building stadiums doesn't work around that. And I think consumers today see through that. So at Lemonade, we work differently. We try to take out costs by using automation and pass those costs on to the consumer. And that's why we're able to price the way we price. And we try to pay claims in 3 seconds rather than drag out the claim, because we want the NPS and the customer satisfaction, and we want to grow our business. We also say to customers up front that if there's leftover premiums, rather than pocketing it, it's going to go to a charity of your choosing, so that we don't have the same degree of conflicts of interest, and that increases trust levels. So we are trying a different playbook with 2 million customers and climbing, 2.25 or so million customers. So far, so good, and we're going to keep doing that.
Really grateful for your time. It was a fascinating conversation. I learned a lot, and I have no doubt that our viewers and listeners did as well. And I hope we could do it again at some point. Continued success. That's Daniel Schreiber, the co-founder and CEO of Lemonade. Daniel, thanks a lot.
Thank you.